Financial markets run on a paradox. While prices are often discussed in the language of rational valuation, the actual day-to-day movements are driven by the emotional forces of fear and greed. Standard Western bar charts plot the mechanical data points of a session, the open, high, low, and close. Yet they lack the visual depth needed to communicate the psychological force behind those numbers. This gap in analysis persisted until Steve Nison introduced a methodology originally developed by Japanese rice traders over 3 centuries ago. This method organizes market data into clear blocks of momentum, allowing traders to see the balance of power between buyers and sellers at a glance. These shapes function as a map of the market's current emotional state, rather than a simple history of its price. By learning this visual language, traders can identify shifts in momentum as they occur, often providing earlier indications of trend changes than traditional lagging indicators. The system traces back to 17th century Japan, as the country transitioned from the feudal age of country at war to the stability of the Tokugawa shogunate. Commerce flourished. This era saw the creation of the Dojima Rice Exchange in Osaka. Merchants eventually moved from trading physical rice to empty rice coupons, contracts for future delivery that became the foundation of modern futures trading. Munehisa Honma, a merchant often called the god of the markets, realized that the price of these coupons fluctuated based on the psychology of the traders, independent of the actual rice supply. To track this psychology, a full day of price action is compressed into a single shape, the candlestick. It displays the 4 core price points of the session in a vertical format. The central block is the real body. It measures the net convention between the opening and closing prices. The color indicates who controlled the session. A green or white body shows that buyers pushed the close above the open, while a red or black body shows the sellers won the battle. The shadows or wicks represent the price extremes of the day, showing where the market reached a high or low before being rejected. This shape reveals the conviction behind a price move, showing not just where the market ended, but how much resistance it encountered along the way. Certain shapes represent moments of extreme tension. A doji forms when the open and close are identical, signaling a total stalemate and peak indecision. Variations like the gravestone doji show a failed bullish surge, while the dragonfly doji indicates a bearish drop that was entirely reclaimed by buyers. The hammer pattern appears at the end of a downtrend. Its long lower shadow proves that bulls aggressively bought a panic dip, potentially ending the decline. If that same shape appears at the peak of a rally, it is called a hanging man. Here, the long shadow reveals a sudden, significant influx of selling pressure that makes the uptrend vulnerable. 2 candle patterns provide even more clarity. In a bullish engulfing pattern, a large green candle swallows the previous red one, signaling that buyers have taken full control of the narrative. The bearish engulfing pattern indicates that supply has overwhelmed demand. This large red candle shows a decisive rejection of higher prices at a market peak. A dark cloud cover forms when the market gaps higher on the second day, but fails to hold. The deep red close into the previous day's gains signals that the bullish optimism has evaporated. Conversely, the harami pattern, meaning pregnant in Japanese, features a small candle contained within the previous day's large body, indicating a sudden loss of momentum. These patterns provide early signals of trend exhaustion, highlighting shifts in sentiment that take longer to register on traditional Western charts. The morning star is a 3-session reversal pattern. It tracks a transition from panic selling to a star of indecision, followed by a strong bullish takeover. The evening star is the bearish equivalent. It marks a peak where a strong rally stalls into indecision before a red candle confirms a reversal. Stronger moves are confirmed by patterns like the 3 white soldiers, a series of 3 long green candles that show a healthy, sustained trend moving higher. Continuation patterns help identify healthy pauses in a trend. A window, or a gap, represents a price area where no trading took place due to extreme momentum. In Japanese analysis, these windows act as support or resistance. A rising window often serves as a floor where buyers step back in during a correction. The Rising 3 methods describes a trend taking a brief 3-day breather before the buyers reassert control and drive the price to new highs. Recognizing these multi-day structures allows traders to distinguish between a trend that is ending and one that is simply rusting. Nison's most critical rule is that candlestick patterns should never be used in isolation. They are indicators of timing, not standalone trading systems. The most reliable signals come through confluence, the merging of candlestick patterns with Western technical tools like moving averages, support lines, and oscillators. Trend context is essential. A hammer is a significant signal when it occurs during a pullback in a primary uptrend, but it is often ignored during a major bear market. A bearish pattern carries significantly more weight when it forms exactly at a long-term horizontal resistance level. Momentum indicators like the RSI can confirm the psychology of a morning star by showing the market is in an oversold state as the reversal begins. Volume data provides final verification, as true trend reversals require a surge in participation to confirm institutional conviction. This structural context also provides objective exit points. The extreme low of a candlestick's shadow serves as a logical level for a stop loss. By combining these Eastern and Western perspectives, a trader filters out isolated shapes and focuses on high-probability signals backed by multiple layers of evidence. It is logical to ask if these patterns still have an edge in the age of high-frequency algorithmic trading. Today's algorithms are frequently programmed to recognize and execute trades based on these exact formations. This automated behavior creates feedback loops across global markets, reinforcing these patterns in the price action of highly volatile modern assets. The risk for modern traders is matching patterns without understanding their context, buying a shape without checking the underlying trend or volume. The emotional intensity once confined to the trading pit now dictates the digital order flow on global screens. Mastery of this language provides a lens to gauge market sentiment, allowing for rational execution even during periods of high volatility.